In today's fundamental video, we are going to be talking about how to use GDP growth and decline to trade currency pairs more effectively. And this is a free fundamental analysis course. We're just getting started. So make sure to hit the thumbs up button and subscribe. Let's jump in. Okay, so first of all, we need to talk about what GDP is. Now, I'm going to assume that most of you guys are very beginner when it comes to fundamental analysis, as it's not very common on YouTube. Most people are focused on the charts and technical patterns, which is cool. We use those sort of things too, but fundamentals are very, very key. So let's talk about what GDP actually is. GDP stands for Gross Domestic Product, and central banks report their GDP growth or decline usually on a quarterly basis. An easy way to think about this is GDP growth is basically the economy's growth or decline. Is the economy growing, things are booming, or are things declining or busting and not going very well for any country? So whether you're talking about Germany, South Africa, the USA, wherever you're talking about, Mexico, whatever country you're talking about, they all have, of course, their growth or their decline. And these numbers can be a huge impact on the currency market. Of course, a growing GDP percentage shows economic growth during the previous quarter, and a shrinking GDP usually will show a decline during the previous quarter. This is usually reported on a quarter-to-quarter basis so that you can see what the previous quarter would have looked like in terms of growth or decline. And again, this is data that we get from central banks on a regular, consistent basis. Today's video sponsor is Audacity Capital, which I'm really excited to talk a little about their brand new program that just released. Audacity Capital funds traders with great opportunities to take their trading to the next level, and I want to talk a little about their brand new program that they have. Basically, it is a challenge opportunity that you do on a two-phase demo account process. What I love about this new program is that it is very hands-off. Check out some of the key details about this new program. Traders can trade things like Forex, indices, and commodities, while also having a much larger drawdown of up to 15%. In addition to this, they have leverage of 1 to 100, which is very high compared to the average opportunity that's out there for a trial phase. Traders can hold positions going into news, and even if you're a swing trader, you can hold positions over the weekend as well. To join the challenge, traders must purchase a demo account with a one-time refundable fee. This means no monthly fees, which is really cool. Some of their old models had monthly fees. This new opportunity allows you to do this without any sort of monthly fees. You just have to pass the examination phase. Traders also have the option to manage an account size that they are personally comfortable with, and there's a generous monthly profit split of 75-25 on the live account. Let's talk a little bit more about drawdown. Their fair drawdown limits look really nice at 15% absolute drawdown on the first stage and 7.5% daily drawdown max. This is designed to make the challenge a bit easier for traders to actually pass. And once they complete the challenge, they will manage a live account of the size that they personally choose. Audacity Capital has been funding traders since 2012, taking them to the next level. If you're interested in checking out this awesome new opportunity, there will be a link down below in the description. Check it out, click that link, and good luck on your journey. So why does GDP growth matter? And as currency traders, is this something we should even be paying attention to? Well, it's sort of the wind in the sail to a lot of the currency market, because GDP growth is very, very important. And currencies, when we are trading Forex, currencies represent the economies that they are being placed under. So of course, the US dollar is representing the US economy to a degree. The British pound is showing the integrity or the strength of the UK's economy, etc., etc. GDP growth figures can have a direct impact on the valuation of currencies relative to one another. When we're trading currencies, think about the currency pairs that we are trading. We're trading the dollar against the yen. We're trading the pound against the dollar, the euro against the dollar. And the valuations of these currencies go up or down relative to the underlying economies that are represented by each currency. So when we talk about, the valuations here, if country A, for example, has a faster growing GDP growth than country B, we would consider that to be a bullish thing for country A. Because again, if growth is happening over here, but it's not happening so much over here, we're going to send our money there. So let me show you visually just the idea that I'm talking about. Let's say that country A over here is experiencing a lot of growth. Things are going very, very well. And people are buying cars, people are investing in real estate, people are having record, business growth, or, people are getting paid more, people are spending more. Good things are happening. But in country B, things are not so good, and they're the exact opposite. People are actually losing, valuations on their companies, and sales are really slow, and exports are really slow. Other countries don't really want what this country has to offer, and this is bad, right? So of course, in this case, where would you as an investor want to put your money? Would you want to invest in somewhere that is shrinking and declining, or would you want to go into a growing, optimistic atmosphere? And of course, the obvious answer intuitively is going to country A. And this is exactly what the major flow of GDP growth is all about. Investors, traders want to be going towards the places where growth is more, happening, where things are going well. They don't want to be investing in places where things are massively declining. And in fact, with that, so again, bringing back our idea of country A and B, of course, each one of these has their own currencies. And we basically can see the valuations of those currencies go up or down based on this metric. If things are growing, that's optimistic for a currency. And if things are declining, that's negative for the currency as well, or the strength of that currency is probably a better way of saying that. So, what does GDP growth actually forecast? Well, strengthening GDP numbers can lead to a lot of good things for an economy, and I hinted at some of those with my previous drawing. But if GDP growth is impressive, or it's growing faster, the percentage growth, for example, let's say we had a 3% growth over the previous quarter, it is expected that a country's central bank may be more willing to raise the holy grail of words here, interest rates. If you're a stock trader or investor in stocks, if you've ever traded stocks, then you may have heard of what is called a dividend, where basically, let's say this is a stack of cash, right? This is a stack of cash. When a company does very well, this is a terrible stack of cash. If you have a stack of cash and your company is doing really, really well, they may elect to choose to give out a dividend, which is a small extra payment that they will take a little bit of their salary, of their profits, and they'll give them back to investors in the company on a sometimes monthly, sometimes quarterly basis. And that's the stock market, but it happens similarly here in the currency market. When we're looking at currencies, central banks have the choice to raise or cut their interest rates. Rising interest rates usually show strength in an economy to be able to afford to pay out a higher rate to investors, and this can attract foreign investment. Of course, interest rates, we have a whole video coming out on that. Make sure to stay tuned for that, or if it's already out, you'll see it pop up on the screen right now. But GDP growth is a leading factor into when central banks decide to raise or cut interest rates. If things are going really well in an economy, generally that can lead to raising that interest rate. So these two things tend to move in the same direction. So when GDP is rising, interest rates, or rates in this case, rates can also be forecasted to potentially rise as well. Higher rates can attract more money to come into this economy as people want a piece of the action. If higher interest rates are offered, that may attract foreign investment and cause the valuation or the demand of that currency to go up, right? So higher GDP, higher rates, that can cause the valuation of the currency to rise. And that is where we would, we want to factor this in. This is really important stuff. And I'm going to show you as we get further in this video where you can find this information and how you can actually trade it. So don't go anywhere. Remember, if you want more content like this, hit the thumbs up button and subscribe to the channel down below. All right, so the benefits of growth will likely trickle down to consumers. This is another important component. If growth is happening and we see that happening, it's going to end up landing in the common person's ability to spend more. The middle class becomes stronger and people have more money to spend, which further allows people to spend, causing more growth and more expansion. This is an important thing when it comes to GDP growth, is that it has the ability to potentially cause more growth and get the ball rolling. And when we take a look at the next page, the opposite is also true. GDP decline can be very, very negatively impactful for currencies that are experiencing their economy declining. So take a look at this with me. Weakening GDP is the exact opposite or inverse effect. And it can be very negative for currencies that have declining economies. Slower negative growth can lead to interest rate cuts. Okay, again, key word here is this little spot right here, interest rate cuts. If you have interest rate cuts in your central bank, that is going to cause the valuation of your currency to almost certainly decline to a degree. And the reason for that is because foreign investment not so attractive. So let's go through. Let's say that you are experiencing slowdown, right? Things are not going well, and growth, we'll put G for growth, is declining. And then to follow up with that, to stimulate the economy, what central banks in that economy do is they decide, well, we're going to slash interest rates. So we'll put R for rates. And this effect is trying to cut interest rates so that people can have lower borrowing costs, get out there and spend, and potentially turn things around so that eventually they can start that. This is why we see cycles happen in central banks so often. For example, this is what happened in 2020. This was a big factor. We saw 2020 be a period of time where growth was declining, and they actually ended up cutting interest rates globally, like very quickly. And that was in an attempt to try and get growth to sort of increase, get people out there buying houses, get their wages increased, things like that, to try and stimulate the economy to a degree. When we see bad stuff happen, interest rate cuts mean that foreign investment may not be coming, right? If you have your money now, you say, well, if we have not this atmosphere, but the first atmosphere where we're seeing decline, you may choose to put your money somewhere else, not here. And that is going to cause the currency to decline, okay? Consumers are less likely or able to spend their money, which also could lead to recession, okay? Now, fun stuff. How do we actually trade GDP figures? Let's say that we go back to our concept with country A and country B. If country A, and we'll draw some stuff out here, let's say country A, again, is experiencing a lot of growth, okay? Things are good, things are on the up and up, and country A is experiencing a boom. And country B is experiencing the opposite. In this case, it's pretty obvious where you would want to actually invest. You'd probably want to say, well, I'd rather sell this and go buy this. And let's put names to this for a second. And let's say that this is, I don't know, let's say this is USD, and this is JPY, which is actually, sometimes a comparable example. So let's say that the dollar has a more attractiveness because the economy is growing faster and the Japanese economy is growing slower. People may choose to sell the yen and go buy the dollar, right? Based on simple GDP ideas. Now, but what about if country A and country B are both experiencing growth? What if we were to change up this example and say, that in this case, now we change this and both countries are experiencing growth. If both countries are experiencing growth, still pretty simple, we're going to go for the one that has a faster GDP growth. The percentage, if it's 3%, let's add a metric here now. And let's say that this country has 3% growth in the last quarter, whereas this one has 0.2% growth. Now, the equation becomes a little bit easier. Now, this one's growing, but it's growing slow. This one's growing and it's growing much quicker. Still looking to sell this one, buy this one, right? That's the idea behind the two different currencies and how we evaluate them with respect to GDP. And conversely, let's say that if this were to be the case where we see actually negative decline for both, how do we trade that? How do you trade if both are declining? In this case, let's say that we had what happened in 2020. We had major decline. Let's say, just for example, it wasn't actually this much. Actually, I think it was more. There was like a 30% drop in one quarter in the US due to COVID. It was crazy. But then let's say that negative 10% on this one, and in this one we have negative 2%. In this case, which currency would you want to buy? Would you want to buy the place that has a negative 10% drop or the negative 2% drop? Pretty simple. We're still going to go for the better of the two, which is the negative 2%, as that is a smaller decline. So you can kind of see where the flow of currencies from one to the other can go. If things are declining terribly, you don't want to be in the one that's super declining. You want to be in the one that's declining at least less, or even finding one that's positive, which brings us to our next case scenario. How do we actually find the GDP data? Let's go take a look at a cool tool. What we're looking at now is called the A1 Edge Finder, and it's a market scanner that allows us to take a look at some of this data. Take a look right here with me. For this particular video, we're going to be talking about GDP growth, but you can also see ahead of time a lot of videos that are going to be coming out on this channel: inflation, interest rates, unemployment, etc. And I wanted to show you guys an example right now of how we use this market scanner to find setups based on fundamental economic data. Take a look at this. GDP growth. We're looking at the Canadian dollar versus the Japanese yen. And let's remember what our practice is here. If we zoom into this area so you guys can see this a little bit better, GDP growth is at 0.8% for Canada, whereas it's negative or negative 0.1% in Japan. This tells us that the Japanese currency is less attractive in terms of a respective GDP growth figure. Now, when we take that into account, is this a more bullish reading for the CAD-yen pair, or is it a bearish one? Remember, let's think about our drawing, right? Country A, in this case, we'll call it CAD, is growing faster, whereas country B, JPY, Japan, is growing slower. Okay, where are we going? We're going to go from the weaker one to the stronger one. That's the simple concept. Now, the reason that this gets a +1 in this category, take a look here. See the GDP growth right here gets a +1 for us. This is one of the ways that we use our market scanner to find the setups that we find. This particular asset the metric that we just talked about, GDP growth, comparing to economies, is the first step one of the first steps that we do when we're trying to evaluate currency pairs to buy or sell. We want to see places where growth is in one place and decline is in the other, to see a clear distinction as to where we think things could go next. And this gets us a buy in this market scanner. And this is, of course, one of the tools that we use to find our setups. We can also scan for so many other things. I have a whole video on this. Maybe we'll drop a card here if you would like to check out the Edge Finder in its entirety. And if you want to get this tool for free, you can actually do so down below in the description. We'll link a Telegram message so that you can send a message to someone in our team. Send them the word Edge Finder and you'll get this tool for free to try out. And we'll also put a link in the pinned comment section as well if you would like to get a free copy of the Edge Finder. Send that message, Edge Finder, to one of our team members and we'll get you hooked up with a free copy to try it out. Thanks for watching today. I hope you got something out of this video. If you did, hit the thumbs up button, subscribe, and see you next time. Looks like it's time for your next trading video. Check out the videos here and here for more free trading content that should help you in your trading journey. We try and keep it real here, so make sure to subscribe for more content that is down to earth, realistic Forex trading content. See you in the next video.